Welcome back. In this video we will discuss cost-volume profit analysis. Let's begin by examining the difference between net income and operating income. As you can see by these two formulas, the only difference is that operating income excludes fixed costs, which are considered sunk costs at the time when operations begin. As the fixed costs are already sunk, managers are trying to find out how much sales minus variable costs they need to achieve in order to cover at least those fixed costs, and ideally more in order to generate a profit. As the level of sales and variable costs are both dependent on the quantity of units sold, managers can isolate the price minus variable cost per unit to determine the contribution margin per unit. In other words, the operating income is the margin to which sales contribute to the profits after variable costs are accounted for. Therefore, the break-even point is the point where fixed costs are completely covered by the contribution margin. Let's look over an example by assuming the role of the manager of a production facility that has fixed costs of $200,000 per year and variable costs of $200 per unit. These variable costs include direct materials, direct labor, variable overhead, and marketing costs, and the price per unit is $360. With these inputs, we can determine the contribution margin per unit, which in our case is $160 per unit. Now that you know the degree to which each unit sold helps cover the fixed costs, you can determine the break-even volume, which is $200,000 over $160, giving us a break-even volume of $1,250. In order to determine the break-even level of sales, we must first determine the contribution margin ratio, which is the contribution margin of 160 over the price of 360, giving us 0.4 repeating. To determine the break-even level of sales, we must divide $200,000 by the contribution margin ratio of 0.4 repeating to get a break-even sales of $450,000. There are two ways we can demonstrate this situation graphically. The first way is the profit volume graph. In this graph, the break-even point is located at the x-intercept. If a manager has a profit target of $150,000, they can use this graph to determine that they need to sell 2,000 units to reach this target. The second way to evaluate this graphically is by separating the graphs into the revenue and cost graphs. Here, the break-even point is located at the graph's intersections. The target profit of $150,000 is the distance between the revenue and the cost. Thank you for watching this video on the cost-volume profit analysis. The following video will include a more comprehensive example of a multiple product break-even point analysis.